Waterfall or avalanche? Take your pick. The Silicon Valley Bank collapse demands our very, very close attention. Hi everyone, I'm Gardner Goldsmith for MRC-TV. Indeed, waterfall or avalanche? If likened to a waterfall, the Silicon Valley Bank collapse that dominated U.S. news Friday and through the weekend was sourced from years of central bank inflation and risk-inspiring federal policies that led to it, and has seen little bits of key information like detritus flowing into view behind it. If an avalanche, the SVB crash has deep systemic central banking roots. It possesses numerous policy triggers and throws at us revelations about untrustworthy media, dangerous, risk-inspiring institutions like the FDIC, and what appears to be justified worry that even as one sees breaking news of New York-based Signature Bank collapsing, this could be just the start of many more collapses, more insane central bank bailouts, even if they're not given that name, and a political push for central bank digital currency, CBDC. Among the news that is crashing around us, all the stories that we can see, we can begin by looking at the absurd character of CNBC investment financial expert Jim Cramer, who, as the New York Post notes, sang the praises of SVB stock in a manner that echoed his dumb 2008 suggestions to not dump Bear Stearns stock just days prior to its collapse.
I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap.
Then there's the off-tune presence of the Federal Deposit Insurance Corporation, aka FDIC, a constitution-defying risk-pumping legacy of FDR central planning and cronyism that not only promises your tax cash to each signatory bank up to $250,000 per depositor as insurance, it, as its own financial entity, well, it has nowhere near the assets to cover all the $9 trillion in risk that it promises to so-called insure. The SVB story is huge, not just because it is the second biggest bank failure in U.S. history. It's tied to a darker history of U.S. central planning, government control of the money system, and government debt, and the inflation boom-bust cycle that they all inspire. And it's a prime example of how the unconstitutional so-called rules and protections politicians claim are for us really are just weapons for them to use selectively as they work on more ways to accumulate power for themselves and shovel assets to those who play the political game. First, a bit of backstory. In 2004, I wrote a piece for the Mises Institute, in which I tried to warn people that the government prohibition of a competitive, free market money system and the simultaneous existence of a government-granted monopoly Federal Reserve, actually, of course, we all know that it only holds a fraction of metal commodities in reserve compared to the money that it pumps out at us. Well, I tried to warn that that was not just immoral and anti-economic. It was, at that time, keeping interest rates near zero and making its coming inflationary tragedy even worse. The subsequent bust wiped out trillions in overpriced investments and saw so many months of GDP lower than the level measured at the end of 2007 that technically it was an economic depression that lasted until the end of 2011. Government spending and borrowing, central bank inflation, i.e. money pumping in order to buy that government debt, and fascist cronyism led to not just the disaster of price increases and overbidding on resources, but to time shifts in spending by individuals deciding to spend their money more quickly. Also to resource misallocation and to the inevitable busts once the average consumer began to see how intensely his or her buying power was diluted by the vast amount of added money into the system. At a certain point, this always happens. The detached from real economic minds at the Federal Reserve begin to raise interest rates, which often, as has happened now, leads to an inverted yield curve. That's what happens when short-term bond rates actually are higher than the 10-year bond, where prices for those lower yield bonds end up crashing. And then both factors not only slam new participation in investment, they make it difficult for fractional reserve banks, such as SVB, to get the liquidity needed to pay depositors' demands for its already lacking available fractional reserves. Once depositors get a sense of this problem, they know they have to get what they can out of the bank before another customer beats them to it. Economist Peter C. Earle has composed for the American Institute for Economic Research an excellent overview of the SVB crash, one that offers wider lessons for all people interested in fundamental economics. In part, he explains, quote, Federal Depository Insurance Company, FDIC, filings indicate that U.S. banks took over $600 billion worth of unrealized losses last year, a large portion of which was generated by precipitously falling bond prices amid the Fed's aggressive interest rate hikes. In addition to holding $108 billion in treasuries during the worst year in history for such securities, SVB's books include $74 billion in loans, a portion of which were undoubtedly extended to local tech companies. Tech companies have recently been under pressure as well and are cutting costs. Earle's mention of the FDIC offers us a key opportunity to more closely scrutinize that particular government creation, and of course to look at the overall idea of government insurance for deposits as well. Not only is there no constitutional provision allowing the federal government to create a corporation, let alone one that promises to insure bank deposits, the mere existence of the FDIC is what economists call a moral hazard. It promises insurance for deposits, which inspires bankers to engage in riskier lending and investment compared to any environment in which they would have to get insurance via real, free market-based, non-tax-backed means. The FDIC isn't just a moral hazard inspiring lending that normally would be avoided in real market situations. In the case of SVB, which, partly thanks to its artificial so-called insurance, was investing in worthless ESG, environmental, social governance projects, the FDIC has now swooped in like a vulture. The FDIC literally has taken control. As Jesse Pound writes for CNBC, quote, according to press releases from regulators, the California Department of Financial Protection and Innovation closed SVB and named the FDIC as the receiver. The FDIC, in turn, has created the Deposit Insurance National Bank of Santa Clara, which now holds the insured deposits from SVB. The FDIC said in the announcement that insured depositors will have access to their deposits no later than Monday morning. SVB's branch offices will also reopen at that time under the control of the regulator. Notice that term, regulator. As I often stress to economics students, that's just a euphemism for threatener or economic fascist. It not only is the immoral near end of a government-inspired economic boom-bust cycle, seeing specially selected people take over assets, seeing the government manage who will and will not get paid what they are owed as depositors, investors, or bondholders of the bank. It also includes something else that's very important. Key figures in government had to have known what was going on here. This special new Deposit Insurance National Bank of Santa Clara couldn't just pop out of the statist oven in a day on March 10th. This tells us that the faceless figures who created the new bank had to have known about SVB's insolvency. This is worse than Jim Cramer applauding the bank mere days before the collapse. This is worse than Forbes recently placing it on its list of best. It's also worse than what we see in reports that Greg Becker, CEO of the bank, sold large holdings in the bank prior to the crash. And it's also worse than the bank runners giving big bonuses to select employees prior to the crash. This indicates that so-called officials worked behind the scenes, not only to replace the soon-to-be insolvent SVB, but that they didn't warn depositors about the financial instability of the institution. This lack of transparency is precisely what politicians like Democrat Congressman Chris Dodd and Barney Frank told us they were fixing when, more than a decade ago, they passed constitution-defying legislation to have the Federal Reserve do annual stress tests on large banks and to make investment firms use accountants that were separate from their own businesses. Curiously, Dodd-Frank also ushered in the obnoxious Elizabeth Warren creation of the Consumer Financial Protection Bureau, CFPB, which, by the way, said nothing about this collapse and sees both it and Liz Warren mum about the FDIC figures behind the scenes who conspired to create a new bank out of the collapsing SVB. And by the way, Barney Frank in 2015 joined the board of Signature Bank. And that would be the New York State-based bank that just failed over the weekend. Are Americans not supposed to notice these towering edifices of graft, fascism, empty promises, and utter hypocrisy? As we see politicians openly oppose any bailout of SVB, and we realize that the unbalanced and unconstitutional FDIC itself likely will get a bunch more of our cash because this entire house of cards is ready to fall and the special people really need our money. And as Treasury Secretary Janet Yellen, the Federal Reserve, and the FDIC scheme for a way to hand out more bailout-like money without calling it a bailout, likely handing big money to big depositors who should have known that the $250,000 maximum insurance from the FDIC wouldn't cover larger deposits. Opening one's eyes to this really lets us see some ugly stuff. And it's been going on for a long, long time. If only people could understand free market economics and freedom. The moral and the economic are together. Thanks for watching, everybody. Please like and subscribe. Remember, you can find us on Rumble where we're not censored. And of course, you can always find us on YouTube as well. Well, almost always. You can always find us at MRCTV.org, that's for sure. And at MRCTV.org, we hope when you visit, you'll contribute to help the Media Research Center continue its work in its 36th year. You can also find us on TikTok, on Instagram, on Twitter, in Facebook. And on Gab, I'm at Gardner Goldsmith, and on Twitter, I'm at Gard Goldsmith. For MRC TV, I'm Gardner Goldsmith.